second question. Here it is. Evaluate the financial acceptability of investment in office pods. And the second part is evaluate using the Black-Scholes option pricing model whether Littlebredy company should proceed with investment in furniture or not for this. So two calculations. Discuss the extent to which investment in furniture and equipment for school and university would represent diversification for Littlebredy company. And the next is advise Littlebredy company on what changes to make in its reporting to provide more information about the rationale for and the factor affecting its future investment strategies. Now you see here. So some questions in AFM, they are just based on your knowledge, overall knowledge and understanding. Professional judgment developed. Okay. That is in the overall framework of AFM. Anyways, we will be opening it. This is the information. So you see here, the first one is NPV, financial acceptability. So word processor and spreadsheet. In the spreadsheet, I will not be doing it here because I have to share its answer with you. So I'll be doing it in the Word and Excel document so that I can share that with you. I'm just telling you. So BSOP calculator for this part is given here. Okay, that is given here. All other are to be done similar. So extent to which, yes, it will work as diversification. So diversification. So B part is diversification like this, whether it is diversification. And the next part is what changes to make in reporting, more information. Yes. C. What changes to make in reporting for more information and the factor affecting its future strategies. Now, so provision of more information. Simple is that. Like this. And here it will be the calculation of NPV, A part. Now, come back. Littlebredy company is a supplier of furniture and equipment. Littlebredy company is listed on its stock exchange and it's subject to a principle-based corporate governance. Is currently considered to investment project. Listed company. It will affect reporting. You know, I am reading it and the requirement is in my mind. I'm linking with all requirements. Now, supplier of furniture and equipment, it is considered to investment. Now, the second part was about diversification. Remember that? One is investment to manufacture office pods. The other is investment in facilities to manufacture furniture. So it is want to enter into different two options of manufacturing. Okay, it's supplier of that. It want to enter into manufacturing office parts or furniture and equipment. Next. So we have to calculate NPV of office parts investment. The investment required for the manufacture of office parts can be assumed to be happen very soon. And production for a full year will start almost immediately. The sale revenue are given here. Contribution is here. Okay. Fixed costs are expected to be 8 million. In first year, rising by 5%. Initial investment non-current asset expected to be $60 million. A tax allowance of 100% is available immediately. The year 4, residual value of investment can be assumed to be 5 million, and this will be taxable. Okay, next. So, this will be taxable. So, the next point is working capital. This is something different. This one, residual value. Working capital at the start of each year is expected to be 10% of expected sales revenue. Any remaining working capital will be released at the end of the project. Tax is payable at the rate of 20% on profit. In the same year in which profit arises, now, tax losses must be carried forward and offset against the profit from the same investment. Tax losses must be carried forward. Okay. The applicable cost of capital for this investment is 11%. Next, let us proceed further. I'm opening the Excel sheet. Yes. So it is a part investment appraisal office ports. Year 1, 2, 3, and 4, and year 0. So the first one is contribution. 24 million, 42.3, 40.1, 34.1. This all is in $1 million. Yes. All these are in $1 million. So this is the contribution. The next is fixed cost. 8 million first year, rising by 5% later on. Yes. My God. Okay. Student, they have told another thing that residual value is taxable. We are calculating taxable cash flows. So over here, what we need to do is we need to deduct, yes, residual value. We have to add, sorry, not deduct. 5%, 5 million. It is taxable. And one more thing over here, which is tax saving on capital allowance. It is the point over here. It is the only, in my opinion, it is the only, the point over here. The only. They say this allowance is available 100% immediately. They said that. Immediately. So it has to be offset against later years. So just see here. So we have to calculate taxable profit this plus this. Okay. Plus this as well. Now it's okay. So this is the taxable profit. Cash flow, we can say, not profit. We are forced to do this calculation like this because 100% tax allowance is there. So tax working. Working one, tax payment. We need to calculate. So taxable cash flows, year 1, 2, 3, and 4. So simply, I will bring it here. Now focus. So tax allowance 100% is available at the start. How much is investment at the start? 60 million. So same is allowance available. And it will be offset out of 60. 16 will be offset against it. Then 33.9 will be offset against it. Taxable profit will reduce by it. Okay. Now, just see here. This plus, okay. So the point is the remaining has to be offset against it. What is the remaining balance? This is the remaining balance which needs to be offset what happened? Just a minute. Sum from this to this. Okay. Still, it is okay, right. Now, this have to be offset against it this year. Out of 60, 16 went here, 33.9 went here, and the remaining is minus 10.1. Okay. Now, listen. So taxable profit. How much it is now? This is 0. These are the taxable profits. So tax amount is tax at the rate of, what is the rate of tax? That is 20%. In the same year. It is 20%. This calculation is clear to you people. Tell me. If there is any confusion in this calculation, do let me know. Any point you want me to re-explain? Is it clear? Tell me. Yes or no? Okay. Thank you. So this tax will come here. Tax is here in front of you. Now, after tax cash flow, we can calculate if we want. Otherwise, that's fine. Initial investment, 60 million. Residual value we have already taken over here. And then is working capital. 10% of sale revenue. At the start of each year. So we need to do working capital working too. Working capital. So 10% of sales, total working capital. You can write 10% of sales. Yes. So it is equal to, at the start of each year, year 0, 10% of 60. That is 6. 10% of 86.4. This is important to write, to do this, show this calculation. That examiner can have idea how you have got it. Students do blunder. They don't mention the calculation. 10% of 77.8. So this is the advance. So incremental capital, incremental working capital. This, what is the incremental? This minus this. This is already available. Total level is this. Additional will be the outflow. You can see. This is currently outflow. Next level, this required. This is inflow. Here is no outflow. Now this is total level, and this whole amount will be released at the end. This whole amount will be released at the end. Because this is now level of working capital. So working capital. Here we are. And the next is net cash flows. It is done. Question is almost complete. Sum from here to here. Now, students, discount rate 11%. This into 1.11 raised to power minus this. So this is the NPV of the project. $14.8 million. The requirement was evaluate. Okay. Now, examiner wants you to, because there is no separate question on assumptions in it. Okay, so you can discuss one or two assumptions as well. Okay, when you are evaluating the final. So NPV of the project is positive. So it should be undertaker. Now, but it is based on multiple assumptions of cash flows forecast, cost of capital, recovery of full working capital, these should be evaluated with due consideration and a sensitivity analysis should be performed before making a final decision about investment. Done. Because there was no separate requirement, so we thought it should be done like this. It should be discussed here. Yes, evaluation. The second part is Black-Scholes model, whether they should proceed with this. Okay. So Black-Scholes model, real option. So a bit quick explanation of the same before moving towards this. I think I have removed that forms. Okay. Yes, here it is. Let me connect my iPad and talk about it quickly. Sorry. So Black-Scholes option pricing model talks about it evaluates, it is basically for the pricing of option. An option has call of exercise price, market price. So when we apply it to the investments, so option to delay the project, we say it is a call option. So exercise price is the investment you pay and exercise the option. Market price is present value of future cash flows. And sometimes exploiting a follow-on project. Follow-on project. That sometime you are going for one project. Okay. So that that becomes a stepping stone for a later on investment. Stepping stone. Okay. So you consider a later on project as well. You are not doing that in isolation. You say, okay, we do this project. Because of it, we will get another investment. Call option. So capital investment in the project and present value of cash flows. Next, that is the market price of the cash inflows. Okay. Now, option to abandon or sell a project. You want to discontinue a project in between. So, put option, right to sell. So, exercise is that you are going to get money for selling the project. And present value of future cash flows to be foregone. For example, in the third year of the project has life of 5 years. And you are going to sell project in the third year. You are going to sell. In that case, what will happen? You will not get the cash flows for year 4 and 5. So year 4 and 5 cash inflows, their present value, you will forego. That is the market value. Present value, that is the price you're paying. That is the price of the project actually. And exercise prices you are getting for foregoing that. So this is the real options. And now I'll proceed towards the question again. They say Littlebredy company has previously supplied furniture and equipment to school and universities. On the basis it is only supplying existing facilities. Calculation suggests that proposed investment would have a negative NPV of 7 million. Okay. However, the government has just announced a major program of support for expansion of school and universities. Over the next 10 years, if this expansion goes ahead, Liberty Finance has forecasted that demand for its products would justify 80 million investment. Expenditure on manufacturing facilities in 4 years' time. The present value of income from this investment is estimated to be, this is the project, sorry. This is the present value of cash flows. Okay. Now it could be, can we assume that all costs and revenue include inflation, the applicable cost of capital 11% and the risk-free rate is 3%. Okay. And then, okay, right. 3%. Standard deviation is 25%. What is the number of year? Over the next 10 years, okay? But after this project, okay, if they do this project, they have this option to do. Okay, this 4-year project, if they do, they get a follow-on project. This is call option. You have to note down these things because I think this cannot be done in the Excel. Okay, the formula is here. Now, so just see here. So I'll be opening it. So I'll try to write maximum data here so that I can share it with you. So that is the B part. That is PA, PE, exercise price, and risk-free rate. Yes. R 3%. 3%. Standard deviation, that is 25%. So exercise price, the investment is 80 million. And market value, sorry, PE, this is exercise price. PA, market value is 52.7 million. Okay, this data is, so what is time, T? You know, there are, yes, T. In 4 years' time, after doing this project, they can do it. They say this investment has negative NPV and the government has just announced this project. Okay, now we have to calculate, so we will mention it here. This project, the project is a follow-on investment and is a call option. So BSOP model will be used to calculate its value. Now we will simply put all the data in it, PA. So when we put all this data in the BSOP model given in the ACCA platform, there is some glitch in it, you see here. So it is not working actually. So what we have to do is let us try it on ACCA platform in another place where this BSOP model is given as well. Okay, so it is glitch in this spreadsheet actually, which ACCA has given access to the students. So if we put all the data in ACCA September exam, where they have given the similar table to us. So what I'll be doing, I'll be putting all the data over there. You see, on the same platform, it will be giving us accurate answer. 52.7 is the market price, which we have decided from the option actually. So 80 exercise price, 3%, 0.03, and 4 year is the time, and the standard deviation, it is how much? Just a minute. It is not 50%. I think I have done some mistake in writing that. So standard deviation is, yes, 25%. Yes. So 25% is the standard deviation. So 25% is the standard deviation. So 20.25. So you see here is the answer calculated by the BSOP calculator. So we need, this is the value of call option, because they have to make this investment option to delay. Okay, option to exploit a follow-on opportunity. These both are called call options. Okay, now we will be discussing its answer as well. So this is what we have calculated. We will simply copy all that option from here, this answer from here, to the word processor, this spreadsheet where we are discussing this answer. So what is relevant to us here? It is the call option, exploiting the follow-on option. Now, so how to write the answer? So the previous part is telling us that the project has negative NPV. Okay, so the previous part is telling us that. So based on, yes, the project has its NPV of negative 7 million. So it should not be accepted. Yes, however, if we consider the expansion, yes, follow on due to follow on project due to government expansion, it may give us future benefits, but still it is not giving us, but still it is not giving us positive NPV as with the future call option value of 5.11 million. negative 7 million, that is the value will be, yes, value, the overall, the net value will be 1.89 million. So this project should be rejected on this basis. This is how it should be. Okay. So then, the extent to which this investment will become a diversification. They are already selling furnitures. Okay. They're already selling furnitures, the company. Furniture and equipment. Now they have to go and supply school and universities. Please note down this point. Yes. Let me type it. In the same. B part, yes. Students, supplying, the company is already in supply of it is already in the supply of furniture and equipment. Yes. And equipment. And if they start supplying office and school furniture, it will be a related diversification. That is, they will remain in supply of furniture, but a new product will be added to their business. Now basically diversification. A new product will be added. School furniture has steady market as it is the basic necessity of the society. Actually, the focus requirement. Extent of diversification, basically diversification is done for the smoothing of profit, consistent profits. The society to have schools. So there will be consistent demand of this product in the economy. But for offices, related furniture is a market which is volatile and highly dependent upon economic activity in the country. In the country. Lower if economic conditions are bad, this demand will decrease. As new businesses will not be established. And upgrade of, and hence demand for furniture will be lower. Moreover, the offices and businesses will not upgrade, make capital expenditures to upgrade their existing furnitures in poor economic conditions. Yes. However, school furniture has one more aspect, that government educational institutions may purchase furniture based on political or government linked suppliers. Yes, government skill suppliers. So these factors should be considered while going for this diversification. Yes, actually we talked about diversification, how well it decreases the risk for the business. Now the next part is reporting, the last part. What advice on what changes to it make it to report more information about and rationale for and the factor affecting strategies. Okay, Here we are. Littlebredy board feels that the company has too many has too many dependent on demand has from the office sector. Hence, it is looking at the investment in the future and equipment for schools and university. It is also considering the production of furniture for other type of organization. Okay. The board believes that the decision it is considering now about investment policy will be important for future direction of company. The board does not want to disclose until they are certain for commercial reasons. Okay, commercial reasons. Next, the fulfill statutory reporting regulation and complies with the requirement of corporate governance code to produce an annual business review. However, it has faced investor and media criticism that analysis and commentary on the business published is insufficient. Recent Littlebredy company's business review has been primarily detailed commentary on highlighted figures from the financial statements in the annual report. The main criticism it has have been that it does not disclose clearly the business future investment strategies and discuss its results in the context of achieving strategic objectives. Media comments suggest that the lack of clear information about Littlebredy strategies has been the main reason why its prices have fallen. Yes. What changes it should make? Students, they are complying with laws and regulation and corporate governance requirement. Okay, they are including that report. First of all, we will start with it. We will start with it. Littlebredy Company. C part. Provision of more information. So Littlebredy Company is providing information in its business review and annual report in compliance with laws and regulation and corporate governance code as well. Now, if you think there will be specific knowledge made available to you about these factors, these type of questions, please, you are doing optional paper of ACCA. You must be able to analyze the situation and draft your answer. You must have your judgment. This is what your examiner says. That's why your examiner says students should read some financial magazines. Okay, you should take part in discussions related to that. Okay, and the forums as well, so that your sound finance approach, that is developed approach towards finance and governance. Right now, so the point is, it complies with that. Okay, as well. And it is true that some business plans cannot be disclosed for commercial reasons unless They are certain. They are certain. Now, but who's demanding? Who's demanding more information? Yes, there is criticism that company does not disclose its future business strategies in annual report. The company provides minimum basic information to and doing the formal compliance only, formal legal compliance only. Now, what they should do? This is the current situation we have discussed. So the company should discuss in its reports the areas of products or businesses it is going to or wish to pursue to keep the investor informed of its ambitions. Yes. And a likely and a glimpse of roadmap for future to achieve its objectives. They may include a separate section in report about this aspect. Explaining current business growth and how it is, and a forward-looking analysis of the business plan, forward-looking, along with its investment plans and interests. as well. So you see here, I have not given anything technical over here. 4 marks it is. We can add one more point. Or one more point just came to my mind. Or the company may produce an integrated report on its operations as well. Integrated report.